This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In the previous chapter, we went through absorption costing, and you saw we had that little bit of messing around dealing with the over or under absorption. Well, as I did say at the end of the lecture, there is an alternative way of costing called marginal costing, which I will work through in this chapter. And to explain how it works and what happens, again, can you go straight to example 1 in the chapter, which in fact is exactly the same example that we worked through in the previous chapter with absorption costing. Everything's exactly the same, except, as you'll see, the solution. Because it asks us, part A, to prepare a cost card using marginal costing, and then to do profit statements again for the months of January and February. So first of all, let's do the cost card. And it starts off exactly as before, that if you look at the question, we make one product, desks. Each desk is budgeted to require 4 kilos of wood. So we've got materials, 4 kilos of wood, and the cost is $3 a kilo, so $12 a unit. Labour, 4 hours of labour. We're paying, what is it, $2 an hour, a total of 8. And finally, variable overheads, it says $5 a unit. Now with marginal costing, we stop there. All right, there are fixed overheads, but that's where the problem occurred last time. With marginal costing, we value the units themselves at the variable costs, and that's what marginal means. Marginal means variable. So there is the marginal cost per unit. Now that's the cost card, but let's go a little bit further, because we do know the selling price. It tells us the selling price is $35 per unit. We know what the variable cost of production is, the marginal cost. I just worked out the cost card is 25 a unit. Again, there are fixed costs. For the moment, we'll forget about them. We'll bring them in later. But let's work out what the profit would be if there were no fixed costs. Well, there's the variable cost of production, the figure from the cost card 25. Here, there are other variable costs. There's the variable selling cost. Of $1 per unit. Now, I did say in the last lecture, selling costs in these sorts of questions are unusual. I've brought it in here just to make the point that as a result, though, since the variable costs are 25 for production, another $1 for selling, the profit we're going to make before any fixed costs is 35 less 25 less 1, $9 per unit. Now that surely is the final profit before charging any fixed costs. And the word for that, and a desperately important word for the exam, we call that the contribution. The contribution is the profit before any fixed costs, or, as you've seen, the selling price less all the variable costs. Obviously, there are fixed costs. The final profit will need to bring them in, and we will. But you must learn the word contribution. The selling price less all variable costs, or the profit before charging any fixed costs. But also appreciate the marginal cost is the production cost per unit, the variable production cost per unit, in this case 25. All right, now let's go on to part B. And work out what the profit is. January, February. First of all, January. Now, a bit like I did in the previous chapter, I will do a full profit statement, but you won't be required to run the exam. I'm doing it to make sure everything's clear what's happening. You won't do a full statement in the exam. It'll want to know what the profit is, but I'll show you afterwards how effectively we can write that almost straight down. However, if I do a full statement, for January, first of all, the revenue, we're selling 9,000 units. The selling price per unit is $35. And so the total revenue, 9,000 at 35, 315. We subtract the cost of goods sold. And to get the cost of the sales, we'll get the cost of the 11,000 we produce, less the cost of the 2,000 that are left in inventory. So first of all, the cost of production. How many are there? 11,000 units. Materials, if you look back, were $12 a unit, so total 132,000. Labour, again, if you look back, is $8 a unit, a total of 88. Variable overheads, $5 a unit, 11,000 units, 55. However, with marginal costing, for the moment we stop there. For the moment, we only look at the variable, the marginal costs. We'll worry about fixed costs later. So the variable cost of production, 132 plus 88 plus 55, 275,000. However, that's the cost of the 11,000 produced to get the cost of the 9,000 sold. Subtract the closing inventory. $2,000 units left in inventory. And because we're using marginal costing, the cost per unit from the cost card, $25. So 2,025 is 50,000, giving a cost of goods sold of 225,000. Now, the revenue, remember, 315, the cost of sales, 225. So a profit so far of the difference of 90,000. Now that doesn't actually have a name. That's like the gross profit, but ignoring any fixed costs. Still ignoring fixed costs, we then subtract any other variable costs. Here there are variable selling costs. It was $1 per unit, but that varies with the level of sales. So 9,000 units at $1 a unit. 9,000. 81,000. Now that 81 is the profit before any fixed costs. This, therefore, is the total contribution. And of course, I could have written that straight down. Because how many did we sell? We sold 9,000 units. What's the contribution per unit? If you look back, it was $9 a unit. And so, again, no need to do a full statement ever in the exam. The total contribution, 9,000 units at the contribution per unit. For the final profit, of course, that's the profit before fixed costs, so we now need to subtract the fixed costs. But this time, no messing around, putting in, absorbing one figure and then having to deal with this over-under absorption. We simply subtract whatever the fixed costs are. Here, the production fixed costs, up at the top, 20,000 a month. The selling fixed costs, 2,000 a month. Total 22,000. And therefore, the profit is 59,000. Have I got my arithmetic right? 81 minus 22. And there we are, you see, so none of that messing around. It's, in a sense, so much more straightforward. And as I said a minute ago, you'll never be asked to do the full statement. If we know the contribution per unit, we can write down the total contribution straight away, the sales times contribution per unit. And to get the profit, we simply subtract the fixed cost, and we subtract the actual figures. None, again, of this business of absorbing one figure and then having to correct it. However, one thing may have occurred to you. I've already said this is exactly the same question that we did in the last chapter when we looked at absorption costing. Exactly the same figures, and all right, different layout here, and I brought in the terminology. But if you do look back to the last chapter, you'll find that we got a different profit. This is the profit using marginal costing. If you do look back to the last chapter, when we used absorption costing, again, go back and check, you'll see all the figures are absolutely identical. But with absorption costing, we ended up with a profit of 63,000. They do give different profits. Now, some people get very upset and say, well, which is the right profit? There isn't. There's an argument, we'll discuss in a minute, an argument for doing it either way. But it is important for the exam that you know why they result in a different profit. I'm not going to wind back to the previous lecture, but if you do look, all the figures are the same. The revenue, if you look back, was 315,000. Materials, production costs, 132,8855. The selling costs, variable, was 9,000. All right, fixed costs, selling costs were 2,000. The fixed production costs, we put in one figure, but then we changed it, the over-under absorption, so we did end up with 20. So why do we end up with a different profit? The reason, and the only reason we end up with a different profit, is the way we value inventory. With marginal costing, you value inventory at the marginal or variable cost of production. And the variable cost of production, the marginal cost, was 25. Inventory is valued at 25 a unit. But if you look back to absorption costing, with absorption costing, we value at the full cost of production. We bring in the fixed overheads of production. And with marginal costing, we got 27. You see, materials were 12, labour was 8, variable were 4. We brought in the fixed production costs. It was 20,000. on average 10,000 units, $2, it was 27. And of course, if you think about it, look at the statements. If you value inventory different, you'll end up with a different profit. And that's what's happened here. Now, say we'll have a chat in a minute about, which shall we do marginal, shall we do absorption? But before we do, for the exam, you must be able to explain why the profits are different. And you must learn the rule. And I've left space, in fact, where is it? Example 2. If you look at example 2, where I've left space, in January, when we used absorption costing, the profit, I can't remember what it was 63,000. Again, look back if you need and check me. When we did it marginal costing, I just showed you the profit is 59,000. The difference is 4,000. Now, the only reason ever for the profit being different is because of the way we value the inventories, both opening inventory and closing inventory. And why do we value inventories differently? Absorption costing includes fixed production overheads, marginal costing doesn't. That difference is always the change in inventory multiplied by the fixed overheads per unit. What was the change in January? At the beginning of the month, there was no inventory. At the end of the month, there was 2,000 units. What were the fixed overheads per unit in absorption costing? They were $2. That is the difference in profits, and you must learn that. You know, plenty of questions say something like, the profit using marginal costing is 59,000. What's the profit using absorption costing? You know, and they give you details of the inventory and fixed overheads. The only difference ever between the profits is the fixed overheads in the inventory. Let's look at February. I'll come back to this table in a minute, but in February, without doing a full statement, what's the profit going to be using marginal costing? The sales, 11,500 units. The contribution per unit, $9. And so the total contribution, 11.5 times 9, 103,500. The contribution, that is the profit before any fixed costs. So to get the profit, simply subtract the fixed costs. The production cost, 20,000 a month. The selling fixed costs, 2,000 a month. And so our marginal costing, what does the profit become? 103,500 minus 22. 81,500. I'm sure you can see why some people prefer this approach. Seems much more logical. And again, none of this messing around, having to deal with the over and under absorption of fixed overheads. We just put in the correct figure. Let's compare the two. With marginal costing, the profit was 81,500. If you do look back to the previous chapter, where again the figures were exactly the same, you'll find when we did absorption costing, the profit was 77,500. The difference is 4,000. Why is the difference 4,000? Well, again, it's the change in the inventory. In February, at the beginning of the month, we did have 2,000 units. At the end of the month, we had 0. So again, it changed by 2,000 units. As an absorption rate of $2 a unit, it changed by 4,000. However, note one final thing before I have a bit more of a chat. In January, absorption costing gave the higher profit. And in January, inventories were increasing. We started the month with no inventory, we ended the month with 2,000 units. Inventories increased, absorption costing gave the higher profit. In February, it went the other way around. The inventories reduced. We sold more than we produced. We started the month with 2,000 units, ended the month with no units. Inventories reduced. And you can see, marginal costing gave the higher profit. If you think about it in the long term, it won't make any difference. Because closing inventory is opening inventory for the next month. But from month to month, we will end up with different profits for the reasons I have explained. And so learn two things here. Learn that the difference is change in inventory times fixed overheads per unit. But also learn which one gives the higher. Look at note 3. Example 3. Example 3. Compare profits under marginal absorption for situations. If production is more than sales, if you produce more than you sell, inventories will increase. It's like January. And you can see for yourself that in January, absorption costing gives the higher profit. B. Well, I bet you can guess the answer to B. If the production is less than the sales, so you're selling more than you produce, inventory will be falling. Well, if inventory is falling, it's like what happened in February here. Marginal gives the higher profit. And finally, I wonder if you can guess if production equals the sales. Well, if production is the same as sales, the inventories won't change. Whatever the inventory is at the beginning, it'll still be the same at the end. You're producing, you're selling what you produce. Well, if the two are the same, if inventories don't change, it's the only occasion when the absorption profit will equal the marginal profit. And for heaven's sake, learn those last two bits. Learn this. Go back and make sure you're convinced. It's awful to learn a rule without understanding. So make sure you are convinced, but otherwise for the exam, learn it. And also, learn that the difference in profit is the change in inventory times the fixed overheads per unit. All right, well, just to finish it off, but much less important as far as the exam's concerned, a lot of people saying, well, which is the right profit? In January, is the right profit 63 or 59? It can't be both. Well, it can be both. There's arguments for either. Now, in financial accounts, there is a rule. We're not worried about financial accounts, but financial accounts, you have to use absorption costing. You have to. And for that reason, many management accountants will use absorption costing, so that they're doing it the same. But management accounts, we do whatever we want. There's no rules. And if we want to do it marginal, we do it marginal. All that matters is we do it the same way each month. You know, we can't, oh, what shall I do this month? You know, you either use absorption costing every month or marginal costing every month. And there are arguments. And a big reason why you might choose marginal is because there's much less messing around. If you were trying to budget, you know, every month next year, and every month you expect to produce and sell different numbers. I know anything's easy enough with computers, but with absorption costing, you keep having to mess around with this over-under absorption. With marginal costing, absolutely no problem. It'll always be $9 a unit for every unit sold. Subtract the fixed cost, finished. So there's no best way, as I say, and it's not your problem for the exam. You do whatever you're told. But I hope I've made it clear. Learn the word contribution. Don't worry about the statements themselves. You won't be asked to produce them. Make sure you can work out, for absorption costing, the profit and this adjustment for over-under absorption. Make sure for marginal costing that, okay, you can get the profit, but that you can calculate the difference always between marginal and absorption profits.